One quick note before we begin. This episode was recorded live at Insurtech Insights USA 2024. Because the show floor was so loud, the audio isn't ideal, but bear with me because the content is worth it. I hope you enjoy.
I'm still focused on new products, niche markets, where actually there's an opportunity to lead with insurance first, but bring in technology where, it makes sense to develop a new product in a specific category where incumbents don't have a digital product, where incumbents don't have technical distribution mechanisms, and, but to build the fundamentals of insurance and then focus on the tech.
Hi, this is Amir Kabir. I'm a partner at AV8 Ventures, and welcome to the future of insurance.
Amir, it's very cool to sit down with you in person.
Yeah.
Not something I get to do often. We're here at ITI, New York City. For people who don't know you, who are you? Give us a little bit of your background and what you do.
Sure, and thanks so much for the opportunity, man. I'm always listening to your podcast, obviously, and others who are doing stuff in InsurTech. So, Amir, I'm a partner at AV8 Ventures, which is an early stage fund in the Bay. We are a generalist fund that invested Series A companies. I came on board 3 years ago to Fintech practice, entails insurance obviously as well. Background, I actually started investing in InsurTech, I think 10 years ago. Got into that coincidentally. I have no insurance background. And then for the majority of my investing career, I felt really something to possibly investments and the world of insurance. And that's how I got to learn more about the insurtech world, and I feel like there's such opportunities. And prior to that, actually, I grew up in Germany and spent most of my time in Germany on the operating side, on enterprise.
I'm glad you said Germany because I actually have no clue where your accent was, and I've been wondering this. It's there's something I can't totally place it.
People tell me that's funny because sometimes people are like, "You don't have an accent." I'm like, "Thank you," and then sometimes it's there's something. I don't know what this is.
It's intriguing. It's enough that it's intriguing and interesting. So Munich Re, for people who know about the ventures investment and the digital partners and all that, you were part of a lot of the early and really interesting InsurTech stuff going on.
Yeah.
I can imagine you've seen a lot of really cool stuff. Are you doing similar? Is it similar kinds of stage and types of companies, or is this a totally different focus that you have now?
It's a little bit different. So maybe a little bit background there. So when I joined Munich Re Ventures, I was number 3 on the team. We just got small fund committed by HDVI. That's where it started out. HDVI is a subsidiary of Munich Re, Hartford Steam Boiler. That's where we kind of started off investing in industrial IoT topics that are related to Hartford Steam Boiler. That's very much focused on the breakdown. And then I think in 2015, this whole InsurTech wave started, right? And we were right in the middle. And Munich Re started Digital Partners, which is much different than what we did. Digital Partners was mostly or only focused on enabling the startups in the InsurTech world and providing them either capacity, reinsurance, some data, or whatever it might be. And we would be on the venture side and investing companies that they might partner up with or not, and vice versa, right? And so we had a mandate, obviously, as a corporate, a venture arm. It had to be strategic, so we had to find, business owners to work with startups and so on and so forth. And it was mostly the case until I left. Frankly speaking, I don't know if that changed that much or not. But for now, when AV8 Ventures, the early stage fund, the traditional early stage fund, there's some intricacies and interesting things that I can touch base on. But for the most part, we're very much focused on very, very early stage founders that could be 2 people in the garage and an idea to, maybe some revenue traction. But I think the most we go is basically a Series A. And there it's basically hey, we kind of missed the seed of pre-seed. We looked at the market and we think it's going to be the winner, and that's where we would invest. From a check size perspective, usually it's $1 or $2 million that we invest. And I've invested anywhere from $500,000 to a company to the most that was $2 million today. So the average for the was $2 million. And interestingly enough, and I think that makes it kind of interesting from the AV8 fund perspective, we are so far, our majority LP is audience, okay? But we're purely focused on financial returns. We have, similar kind of endeavors from the LP as any other fund, and quarterly, touch bases and quarterly updates, but we have no strategic mandate here to, find partnerships and what's that.
So you're independent, but there's a connection there, but you're not, it's not a mandate.
Correct. Yeah.
So it's an interesting time in investing in fintechs, fundraising, or VCs raising funds. This is like interesting to me. It's been tough for the past few years. When I was starting to study NYU, so I started out there with the dilemma where it's like SNG, for example. So this would apply to those who in the past, right? Your investors, traditional VC investors, will expect a level of that traditional capacity to be extremely important to probably not the right distribution. Because that means one of the two has to do getting into that capacity. So it's just like it's happening too. From your perspective and your history, what's your take on that? Is this sort of like the end, or is there like a
great topic and question, because that comes up every time I talk to founders. And so when I look at the portfolio right now at AV8 over the last almost 3 years, every single investment has been an MGA or a full stack carrier.
Okay. So you've been right at the heart of this.
Exactly. So it tells you what I'm kind of interested in, and I tell you why. And again, I'm happy to take the challenge and go on, but I think if you want to make money in venture, and specifically in insurance, you have to somehow take risks. And you somehow have to touch the consumer in one way or the other. Because that's where eventually the scale comes from. When you look at like exits on the one hand, which are, let's say, the enablers, right? And on the other ones, the challengers, which are the MGAs and carriers. The exits on the enabler side, if it has been a strategic exit, the max was around, I think, 300 million, right? I think the one that sold for like 2.3 billion, the Assurance, that hasn't paid out that well. Just shut it down, correct. So it has been tough, right? And so, as you probably know, and everybody, like selling to insurance companies is probably not, the easiest endeavor, right? And even if you get that going, scaling that up is also not. So that's why, from my perspective and my interest in terms of investing, I'm still focused on like new products, niche markets, where actually there's an opportunity to lead with insurance first, but bring in technology, right? And the investments to date I've made are really focused on like niche markets or developing markets where, it makes sense to develop a new product in a specific category, where incumbents don't have a digital product, where incumbents don't have like technical distribution mechanisms, and, but to build the fundamentals of insurance and then focus on the tech. Because then I feel like, as you mentioned, yes, there is a challenge in terms of scaling, and I've seen it right now, right? But given that I have, invested for the last 10 years and kind of, really thought about the market and talked to a bunch of people, I am okay taking the long-term risk, because like I feel if you invest in the right categories and niches, even if it takes longer, it's a good outcome. Here's a good example I feel that people should think about. If you invest in SaaS and whatever enterprise software, the moat is limited, I think, right? So anybody who is good at coding and some money can probably come and replicate it in one way or the other, and then has to find a good market strategy. If you build an MGA as a carrier, if you make that happen, you have a product, you have reinsurance, pricing, distribution channels. You already have a head with like
there's a lot more someone would need to replicate and
Correct.
be better on.
Correct. So basically, it falls into like the hard tech category where it's like not easy to replicate. Anything is replicable. The question is like time, effort, and process, right, and money. But I think that's where I feel a couple of examples. Invested in a full stack carrier that is focused on life insurance in Latin America, right? Market super underpenetrated. No digital capabilities from any incumbent, underserved market. So you're basically not fighting with anybody there. So you're actually grabbing market share. I don't know the right metrics there, but just as a highlight, I think 80% of the customers who sign up have never bought in life insurance before. And then if you enable that with a digital tool that you can basically onboard customers quicker, give them a better experience with the fundamentals that are aligned, well, then I think will work out, but you need more time. Right?
as you look forward, do you think there are certain types of companies that are like saying like the enablers versus challengers or something else? Do you think there are certain types of companies that are better positioned to take investment than others as we look at what does it mean for investors going forward? Or do you think there's an investor for every type of opportunity? It just has to be a good opportunity regardless. Like, is this paradox real, or is there a path ahead regardless of what your focus is?
I mean, one thing changed in the market, and I think that's because of the outcome of the InsurTech wave one, right? The lemonade, stakeholders and rules and whatever. And I have a tremendous respect for these guys for pulling it off, going public. And it seems also that Root is seemingly doing well again. So I think that kind of is a good indication in the market that, you can turn into profitability. But again, the question is at what price and what time and what money. And so I think there is a breadth of investors for anything out there. And I feel the market has changed from the VC perspective. It's like, oh, we don't want to take risk anymore. We're now focused on the enabler side. But then again, you have to also think about like, this is not going to be like a cakewalk there too, right? It's not that just because you sell software, it's going to be quicker scalable. Yes. It's very hard, I feel, to compare insurance in general to any other kind of category where things scaled up quickly, right? And so, yeah.
I do think on Root, Hippo, Lemonade, maybe not all three of them, but at least to an extent, they just went public too soon. Like I think Root getting to a better place performance wise, and I wasn't in any of the deals, so I don't know what pressures they faced or whatever. But I feel like, and I thought this when they went public is like it's not fully baked. It needs more time before that level of scrutiny and mudslinging and everything. Like it opens you up to a tremendous amount. And it's easy for me to say that on the sidelines.
Listen, I think you give 2 cents there because I feel it's not only the InsurTech that did it, because I had other deals and I had another deal. It was not an insurance and they went to public to the SPAC as well and they didn't end well as well. So I think the market at that point of time was just, pushing a lot of people to do a lot of things. And again, I feel, on the InsurTech side, the founders wanted to have like a great outcome, and that's like the dream of every founder, right? Like similar to a VC, it would be my dream is to invest in a seed company and take it to IPO, right? And I think that's where the market pressure came in, the hype for InsurTech, and everybody thought maybe it's a good idea, and then it turned out differently. But you're 100% right. I believe it was way too soon because the fundamentals were not aligned. And maybe people thought like, the public market will give in and be like, okay, we'll just, look over this. And
which sometimes they do, but
sometimes they do, yeah.
Oftentimes that bubble bursts.
But again, I just wanted to mention that I don't think it's with only InsurTech. There's other companies who went SPAC. Look at the whole like EV space, the autonomous vehicle space that went.
And the EV space, I mean, both
of them, like none of them worked out. Actually, the InsurTechs are better off because they had at least some revenue.
Inshur just folded like last week, or sort of.
Yeah.
I mean, basically shut down. Yeah.
Sorry, autonomous trucking companies, they all shut down or acquired. Exactly. So I think, you have to look at the whole market, and obviously we are in insurance and everybody looks at that. But I think, again, also from the VC perspective, for me, it's also to explain to LPs and others, like, hey, there is opportunity. You just have to look at the right things. And again, I'm not saying everything I invest right now will 100% work out, but at least I have a thesis about it. Yeah.
I'm curious your take on SPACs.
I mean, I think with everything in investing or everything in public markets and finance and whatever it is, it's similar to insurance. It comes in waves and goes, right? And I think given the market environment where we were a couple of years ago, this was the right tool to do that. And I feel a lot of people got rich just because of that and took advantage of this, because at the end of the day, you and I could have done a SPAC if you had enough money to pull it off and make some money on the side, and then the company, whatever happens, that happens.
Yeah, you get your transaction upsides and you're good.
I don't think it's a bad thing to keep an eye on, but make sure that your company is doing well and can sustain the public markets.
I feel like for someone to go public through a SPAC right now, my immediate thought is, what's wrong with their business that doesn't allow it to stand up to the scrutiny of an IPO? And I know it's more than just that, but it does, I would be worried about the signal that sends. Is like, we need to short circuit the process. because we wouldn't stand up to that scrutiny.
Yeah.
And maybe that's wrong, but personally, I would wait until I could take the pain of a full IPO process, because of, I think the SPAC kind of image is tarnished, and it's a signal that there's a reason you're going.
And the other thing, I mean, I don't know if you saw, but these days people are speaking about, if you want to even go public, you need $1 billion in revenue.
Yeah.
Hey, back in the day, if you had 100 million, you were king. And now $1 billion,
You're a small business at 100 million. When I ran a small business team, our top revenue number was 35 mil.
Yeah.
And we didn't call it small business because our boss was like, I think if you're a $35 million business, you'd feel really successful. You wouldn't feel like a small bit, you'd feel like that was downplaying what you'd built.
Yeah.
And today it's 35 million. It's a lot of money.
Yeah.
But you need to be a unicorn now almost.
But I think one thing, I think the company just went public in the InsurTech space. What was the name? Bow something. Bowhead. And they I think it was an MGA, 500 million, and I think premium, I think combined ratio under 100. And I think their market cap right now, just looked it up this morning, was an 800 billion. So I think, and that was always,
that's more rational.
yeah, I think 1 to 2 times premium, let's say 3 times premium, I think it's totally justified. But 10 and 20, I don't know if that's really,
I say that's more rational, and then I think about some established players and what their market cap is relative to their premium size. And I don't even know what Chubb or Travelers or whoever's worth.
It's mostly 1 to 2x. I looked it up a long time ago, but it's not much more. And I always was like, hey, okay, you are a new player in the field. You have some sophisticated tech. I get it. Let's give you 3x. But,
So 500 to 800 is right in line with that. More of what a traditional. So that's
And I mean, I think what excites me these days, not just invested in one, is in the ENS space, right?
Yeah.
I mean, look at Skyford and Kinsale.
Yeah.
I mean, these guys are public, also the same, market cap, and look at them right now, 6 million. Because they grew into that regular business. And I think, again, it goes back to you have to have the breadth to stay the insurance wave of growing. This is not going to be a 5 year to 7 years. I think it's more like a 10 to 15 year.
Well, and so I came out of specialty lines, admitted and ENS at both of the places I worked. And to be successful in specialty lines and ENS, it forces you to be really good underwriters, because that's what the business is. It's expert underwriting. And that's been what's missing in a lot of the earlier InsurTechs. It's the fundamentals of underwriting weren't there. So I'm not surprised to see what Skyward or Kinsale have done, because you can't be in that space and be a terrible underwriter. You get burned really fast. And the brokers will know it.
And I think also compared to the InsurTech Wave 1, which was mostly focused on the traditional business side for auto renter, I always say there's just so much in the right? I mean, at the end of the day, what about auto underwriting? It's mostly prices for where you live and creditors, whatever it might be. So I think there was a lot of InsurTechs who tried to disrupt that. But you can try, but the regulatory body will not allow you. You have to go through all of the cycles. And at the end of the day, I always tell people, everybody has auto insurance. Okay, right now, let's say $100. If an InsurTech comes out and tells you it's 90, is it worth the effort? Yeah, I don't think so. But if you tell them 50, yeah, but it's hard to do that.
Right, yeah, viably. I appreciate you sitting down. I know we're going to get kicked out of this space soon, but thank you so much for sitting down, man.
Thank you so much for having me.